Um, First and foremost, I'd like to give all praises and glory and honor to Yahweh Ba'Shem, Yahweh Shai Ba'Shem Akarkadash. Double honors to the elders and apostles of Great Millstone, preaching His word truthfully and sincerely. And shalom to the Akim scattered through the four corners of the globe, preaching the word truthfully and sincerely. And shalom to the Akim that be like unto the speckled bird, preaching the word truthfully and sincerely. And I say shalom to you, Akim, out there. And this is a sit-down lesson for In the News, December the 14th, 2022, at 3:50 p.m. Central Standard Time on this Wednesday afternoon. And I say shalom. And this was a announcement said about like a couple of hours ago, because I seen it on Yahoo News too earlier today. They were saying the federal tax hike was the highest since 2007. And then you got an article from the Wall Street Journal and from the U.S. economy, and it says Feds raise rate by 0.5% percentage point signals a more increase is likely. Most officials pencil in plans to raise rates above 5% next year, higher than previous expected. And it says the federal chair, Jeremy Powell, Center in Washington last month had previously signaled that central banks will slow the pace of interest rate increase. And this is a news article from by Nick Tim Russ, if I pronounce his last name right. And this was updated December 14th, 2022 at 2:21 p.m. Eastern Standard Time from the Wall Street Journal. It's this news article right here. Continuing on with the reading. From Washington, the Federal Reserve approved an interest rate increase of 0.5% percentage points and signaling a plan to keep raising rates at its next few meetings to combat high inflation. The decision Wednesday marks a step down after a four consecutive large increases of 0.75 points and raised the benchmark federal funds rate to a range between 4.25% and 4.5%, a 15-year high. It says more officials pin its plans to raise the rate to between 5% and 5.5% next year, with the median projection implying the further 0.75 percentage point in rate raise in September. They anticipating lifting it around 4.6 by the end of next year. Officials made hardly any changes to their post-meeting policy statement, which continues to describe an ongoing increase in interest rates as approach. Most officials expecting making somewhat less progress on inflation next year than they have expected in September. They projected more core inflations will exclude volatile food and energy categories to fall from 5% on an annual basis in October to 3.5% at the end of next year. This is up from the projection of 3% in September. And it says the 2023 outlook, the KPMG chief economist Diane Swamp and Duke University economics, a former senior and advisor Ellen Mead to join the journal chief of economics December 15th to discuss the federal, which is tomorrow, the Fed's latest move and the impact on the economy, housing, and jobs markets for next year. The Fed's officials said that combat inflation is primarily by slowing the economy through tightening financial conditions such as higher borrowing costs, lower stock prices, and a strong dollar that curbs demand. The Fed funds rate influence other borrowing costs throughout the economy, including rates on credit cards, mortgages, and car loans. The federal rate increase this year has asset prices and are causing a significant slowdown in a rate-sensitive sectors of the economics showing as housing. But in recent weeks, a long-term bond yields have tumbled as investors anticipate a speedy decline in inflation possible due to recession next year. Economic projected release Wednesday shows officials expected their interest rate increase will slow the economy over the coming year and push up the unemployment rate to 4.6 and next year from 3.7 in November. Historically, an increase of that much that span has coincided with a session.
Eating on that old ass birthday cake.
Whatever.
Give me my shit.
Yeah.
Where that motherfucker at?
Oh, right there, charger.
I can't see shit. That glasses don't even wear the motherfuckers. I'm gonna start wearing them bitches.
How LaShawn and them doing?
She at home.
That's
Over
good.
there cooking potatoes and chicken.
Yeah.
Yeah. You sitting back, he good.
Salaki, I was talking to my big brother. But continuing on with the news article, we're down to the downer part of it. It says Fed rate increase this year have an asset price are causing significant slowdown in rate sensitive sectors of the economy and housing. But in recent weeks, long-term bond yields have tumbled as investors anticipated a speedy decline in inflation possible due to the recession next year. I read that part. I read those two parts already, Salakia. Go to the next slide of the article. It says many officials advise down their economy growth outlook for next year, with a couple of them projecting declines in gross domestic products. Most see the economy expanding by 0.5% next year, bearing before accelerating in 2024. Wednesday's decision capped a year with the Fed raised from nearly zero at the fast pace since the early 1980s to fight inflation, which reached a 40-year high in June. In recent weeks, officials have signaled that they are entering a new phase of policy tightening, which they would try to judge how much higher the needs to rate hikes. So yeah, this has been the highest rate hike of Federal Reserve. Jeremy Powell made that announcement earlier today, and this federal rate tax hike increase of 0.5 to 0.7%, and it's been the highest increase since 2007 as they continue to fight the pace of slowing down the inflation. Once the inflation keeps increasing, cost of living, gas prices, and consumer spending as well too. But continuing on with the next slide, it says federal policies consult this spring around plans to raise rates by half percentage points each meeting until they saw evidence inflation was slowing. Almost as soon as those plans come together, Federal Chair Jeremy Powell decides to accelerate the increase, amending fears that very high inflation will lead to consumer and businesses to expect prices to keep climbing. Right, because you're going to see that potentially increasing all the way into 2023. Expected prices to keep climbing rapidly, causing higher inflation to persist. The central bank lifts rates by 0.75% points in June, the largest increase in 28 years. Okay, so I'm going to go to the next article. And then this is a news article from Barron's Market. from December 14th at 4:55 p.m. Eastern Standard Time. And this is a data statistic shows that the what happened today with the Dow Jones, the S&P 500, and the Nasdaq. As you see this graphic bar shade, the Dow Jones was up earlier today and it crashed, I believe, to like negative 142 points because I see the data statistic of that. And along with the S&P 500, it had a solid gain and it crashed all the way down, along with the Nasdaq fell all the way down as well too. So all three of the Dow Jones Industrial, S&P 500, and the Nasdaq, they all crashed today. And reading this part of the article right here, it says from Barron's.com of live market coverage as of December 14th at 4 p.m. Eastern Standard Time. And it says right here, it says stocks edge higher Wednesday. It decreased ahead of the latest decision on monetary policy for the Federal Reserve, with the central bank's next decision on interest rate widely expected. Investors will be closely watching for clues on further future moves. And it says the stocks closed red, which is in the negative area. Wall Street just can't shake its Fed's fear. And it says the stock ended in red Wednesday after the Federal Reserve decisions to lift its benchmark leading rate by half percentage points. Wall Street made clear it has lingered worries about a rate climbing even higher, right, with the inflation. It says, and not coming back down. The Dow Jones Industrial fell negative 142 points, or 0.4 points. The S&P 500 dropped 0.6% and the Nasdaq Composite declined to 0.8%. The index has been solidly in the green before the central bank announcement. The latest increase is smaller than the previous four, which each were 0.75 percentage point. The central bank started raising rates in early spring to try to cool the red-hot inflation. It says the new government data out today shows a 7.7 gain in prices year over year in November, significantly lower than the peak of 9% increase in this summer. The rate increases are meant to dampen economic demand, which brings down prices. With the inflation on the decline, the Federal Fed stepped back for bigger increase. It says still the central bank noted that more rate increases are on the way. Right, just like they made that announcement today with the 0.5% of federal tax hike increase announced by the Federal Reserve. It says the Fed's dot plot shows that the vast majority of its members sees the federal funds rate going above 5% in 2023 and staying here for the year. Central banks using smaller rate hikes is treading lightly. The Feds acknowledge that The Fed acknowledged that already higher rates should keep driving economy demand and inflation lower, and the central banks made it clear that it doesn't want to put the economy into more than a mild recession. It says, but the dot plots make clear there's a risk if inflation remains too far above the target 2%, that the federal works may not be over quite yet. Most importantly, we should acknowledge that increasing rates are going to stay high for longer and continue adjustments that the economy and markets have to deal with, wrote Peter Brookvar, a chief investor official in Berkeley Advisor Group. That's why bond yields edge up on the Fed news. A 2-year Treasury yield, which attempts to forecast the level of the federal fund rates a couple years from the presented roll to 4.245% from above 4.2%. The 10-year yield was up just over 3.5% for the under that levels early in the day. The pressure that pressures the stock market, right? Because the stocks they react to what's going on economically, globally, the data statistics, and what's announcements of the Federal Reserve, what they have, they ongoing, consistently meetings that they have as they continue to tackle the inflation, as they start to see moving forward ahead of 2023, a potential forecast of a economy is going to be in a mild recession. So the stocks react what's going on globally, economically, data statistics, and what's gonna the announcement comes from the Federal Reserve if they're gonna increase the federal tax hike to ease the inflation. So the stocks goes off of that. It reacts to that. If it reaches the negatives area or the positive ratings, so it's a balanced scale of that, some type of sense. It says the pressure, the stock market. The market has rallied all week, punctuated by the big jump in stock prices after Tuesday's CPI inflation. Right, because they had good solid gains from Monday and Tuesday. Now Wednesday it all crashed after the Federal Reserve made that announcement, increasing their federal tax hike from 0.5%, which been the highest since 2007. It says the markets has rallied all week, punctuated by a big jump in stock prices after Tuesday's CPI inflation report, but it has quickly fell once it became clear that the Feds is planning to hold rate higher for longer, wrote Chris Zachary, the chief investor official from Independent Advisors Alliance. And it says the S&P 500 before the release was up 13% from the lowest close of the year, hits in early October because the investors were anticipating the dovish Feds. Instead, they got the hawkish inversion. Overall index remains above key levels and yields remain lower their multi-year peaks. The S&P 500 around 4,000 points remain above the key 3,900 level, signifying that there are still some buyers at current levels, particularly because the inflation is still declining on the Fed could change its tune early next year. Right, that's just a slow pace of the inflation, but the inflation is still at a high rate, even though it's showing somewhat decline of that. It says the federal said in assessing the approach, standing up monetary policies the committee will continue to monitor the implications of incoming information for the economic outlook. The committee will be prepared to adjust stance on monetary policy, which most federal officials considering risks to be tilted to the downside. It's fair to say there are far more worries about the economic outlook that they are willing to admit, wrote Seema Shara, chief global strategist at Principal Asset Management. At his news conference, Federal Chair Jeremy Powell said that the central banks could soon move to even more smaller rate hikes. Right, that's for the near future coming up. He says for the short term, don't surprise to see more volatile. So yeah, as we see the markets have crashed today as the Federal Reserve increased the federal tax hike to 0.5%, been highest since 2007. As the outlook for next year of 2023 that's coming up, expect to see a mild recession, the continual increase of gas prices, oil productions, consumer spending, as the Federal Reserve's in the near future gonna plan more announcements as they have more meetings as well too of a potential a federal tax hike once again to continue to ease the inflation as they see more warning signs of a mild recession as they continue to tackle the inflation. Supposedly that they say currently right now it's slowly declining, but of the upcoming outlook of 2023, expected to see the inflation going to increase while they continue to tackle the inflation, you know. Salakia. And so with that, I hope this lesson was edifying through the spirit, power, grace, and mercy of Yahweh Yahushua. And first and foremost, I'd like to give all praises and glory and honor to Yahweh Ba'ashem, Yahushua Ba'ashem Akakadash. Double honors to the elders and apostles of Great Millstone, pushing his word truthfully and sincerely. And shalom to the Akim, scattered through the four corners of the globe, preaching the word truthfully and sincerely. And shalom to the Akim that be like unto the speckled bird, preaching the word truthfully and sincerely. And before I close out this lesson, the sit-down lesson for December 14th, 2022, 4:11 p.m., involving the stock markets have crashed today as the Federal Reserve made that announcement of a federal tax increase to 0.5%, which is the highest since 2007, as a upcoming future in the 2023, expected to see the economy be a increase of a recession, a warning sign, according to the experts of in regards to finances and marketing and stuff like that. You're gonna expect to see the consumer spending increasing, gas prices increasing, the inflation's increasing, even though it's slowly declining, but it's gonna increase right back up for 2023 very soon. So that shows you a sign that modern day Babylon is falling, you know, modern day spiritually, modern day Babylon, according to the scriptures. You can read that in Revelations 18:2, I believe, of reference scripture, in Jeremiah 51:7 through verse 8 and verse 9. It shows a clear indication that this is a modern day Babylon, according to the scriptures. You know, especially on the economic sense, we're seeing Babylon is definitely falling on an economic scale as we see these markets crashing, and it's gonna further lead to all the way to potentially 2023 with the inflation increasing, consumer spending, and the gas prices. All those three categories is gonna increase, so that's gonna potentially affect the markets as well too. As I mentioned again, you know, the markets react to what's going on, of the Federal Reserve making announcements, of the markets of these companies and CEOs and these business companies, etc., and what's going on financially, data statistics with the jobs, the unemployment rate, etc. So that's what the stocks and markets react to, if it's react to it in a negative sense or a positive sense. So that's how the stocks and markets react to what's going on financially, globally, data statistics, or any meetings or announcements of Federal Reserve, or what they're gonna make, if it can lead to a positive gain or a negative gain. So with that, I would say shalom in a ball.